In this episode, we are going to be discussing income. What is it? When is it taxed? And who has to pay the tax? So let's get started. Gross income is defined under Code Section 61, and it states that gross income is all income from whatever source derived. Congress left to the interpretation of the Treasury Department and the IRS how to define the limitations on income. So in a case by the name of James v. U.S. in 1961, the Supreme Court then defined what income would be, and that it made clear that all sources of income are allowed to be taxed unless excluded by Congress. And so what was James v. U.S.? Well, the defendant Eugene James was an official in a labor union who had embezzled more than $738,000 in union funds. He also didn't report these amounts on his tax return. He was then tried for tax evasion and claimed that in his defense that the embezzled funds did not constitute taxable income. His argument was that just as the receipt of loan proceeds is not taxable to the borrower because the borrower has to then pay back that loan, the person who embezzles money should not be treated as having received money, since that person is legally obligated to return those funds to their rightful owner. So Eugene James actually pointed out that the Supreme Court had made a previous determination also in Commissioner v. Wilcox. However, this defense was unavailing in the trial court, where Eugene was convicted and then sentenced to 3 years in prison and told that he had to pay tax on the $738,000. So when it came to the Supreme Court, the issue that the Supreme Court then had to deal with was whether the receipt of embezzled funds constituted income taxable to the wrongdoer, even though an obligation to repay exists. The majority opinion was written by Chief Justice Earl Warren, who, joined by Justices Brennan and Stewart, held that if a taxpayer receives income, legally or illegally, without consensual recognition of obligation to repay, that income is taxable. So there had to be a contract that the amount had to be repaid in order for the $738,000 to not be treated as income to the person who took those funds. The court noted also that the 16th Amendment was not limited to lawful income, which is a distinction that has been found in the Revenue Act of 1913. So the absence of that lawful quote-unquote modifier indicates that the framers of the 16th Amendment therefore had no intention to safe harbor illegal income. So the court expressly overruled here the case that Eugene James was citing of Commissioner v. Wilcox, and then ruled that James was therefore liable for the federal income tax due on his embezzled funds. The court also ruled, however, that Eugene James could not be held liable for the willful tax evasion charges that he was initially tried in trial court, because it's not possible to willfully violate laws that are not established at the time of the violation. So, what was the effect of the decision? Although Eugene James avoided criminal liability, the opinion of the court left Eugene James in a situation where he would be required not only to repay the embezzled $738,000 to the union, but would also be required to pay federal income taxes on the receipt of those funds, just as though he had been able to keep them. Whoa! This is so intense! So this is one of the reasons why you have illegal organizations wanting to make sure that their taxes are done correctly, because even if funds that are taken or funds that you find may have to be given back, that does not mean that you don't have to still continue to pay taxes on those funds. What? Oh my goodness! Mind blown, right? Let's talk about what they were talking about when it came to those loans. There is a concept called the Recovery of Capital Doctrine. So the Constitution grants the ability to tax income, but it didn't define income. So this is where James v. US became very important, because the Supreme Court made it clear that all sources of income are subject to tax unless Congress specifically excludes a type of income. So Congress could therefore tax gross receipts. You receive funds for a product that you sell, but you don't take a deduction for the cost of producing that good. So taxing on gross income is actually a bad idea. And why is that? Well, let's give an example. Last I heard, there are only 3 producers of aerosol cans. These are things like hairspray, shaving cream, anything that requires aerosol to be able to produce. And the difference between the sales price of a can of aerosol, using aerosol, versus the cost to produce that can results in a net profit of 1/2 of 1 penny. Well, if it costs the consumer $1 to purchase that, and the company receives $1, we're not going to consider middlemen and distributors and stuff like that, but the tax on that gross would be so much more than the 1/2 penny that is produced that there would be no point in actually producing those aerosol cans. You'd wipe out an entire industry. So gross is not the way to go. So instead, the Supreme Court came up with the concept of Recovery of Capital Doctrine, which states that there is no income subject to tax unless the taxpayer has recovered the capital invested. So the taxpayer gets to recover what he paid for an asset before he has to recognize gain on that asset. Kind of like the sale of a house. You get to recoup the cost that you put into it. So if the house was worth $200,000 when you purchased it and now it's worth $300,000, you only have to pay potentially the tax on the $100,000 that you receive as sales proceeds. From the sales proceeds, that is in excess of what you paid for it. All right. The term income was defined in Merchants Loan and Trust Company v. Smietanka. I'm hoping I said that right. If I didn't, please let me know. The courts were thus required to interpret, quote, the commonly understood meaning of the term, which must have been in the minds of the people when they adopted the 16th Amendment to the Constitution. So early in the history of income tax, 2 competing models of taxation emerged. The first being economic income. This is where economists measure income by first determining the fair market value of the individual's net assets. Assets minus liabilities at the beginning and at the end of the year. The difference between the beginning and ending balances, the change in net worth for the year, is increased by the value of the goods and services that person actually consumed during the period. Okay, it's getting more complicated, but then it gets even more complicated. This also includes imputed values for such items as the rental value of an owner-occupied home and the value of food a taxpayer might gross for personal consumption. There is a reason why this was not chosen. It's because it was a bad method of identifying income, because annual valuations would make this super complicated and maintaining compliance burdensome. It also would cause controversies between the taxpayer and the IRS over valuation. Everybody would have a say. Everybody would then nitpick at what the rental value of a home should be or the food a taxpayer might gross for consumption. So instead, the court decided on the accounting income, the definition of accounting income. This is founded on the realization principle that recognition does not occur until income is realized. So what are these two terms, recognition and realized? Well, realization means an exchange of goods or services must take place between the accounting entity and some independent external party, and an exchange where the accounting entity must receive assets that are capable of being objectively valued. So, income then is recognized when an employee embezzles his or her employer's funds, the income from an illegal business is realized, and when a person discovers buried treasure. So now, I just want you to bask in the creation of burgeoning tax law right now. Think about it. Back in 1921, when Merchant Trust Company versus Smetanka was ruled on, the courts actually defined income for the first time. Oh my goodness. Okay, we're gonna move on because I'm getting a little bit too nerdy here, but all right. So in summary, income represents an increase in wealth only when it is realized. Okay, so now let's compare the timing of income rules for tax and accounting. The timing of the inclusion of income does depend on numerous assumptions though. It depends on your choice of tax year, your choice of accounting method, tax doctrines, and elections. So tax accounting and financial accounting can be very different. For example, unearned prepaid income received by an accrual basis taxpayer often is taxed in the year of receipt. For financial accounting purposes though, such prepayments are not treated as income until they are earned. The Supreme Court explained the variations between accounting and taxable income in a decision involving inventory and bad debt adjustments. Quote, "The primary goal of financial accounting is to provide useful information to management, shareholders, creditors, and others properly interested. The major responsibility of the accountant is to protect these parties from being misled. The primary goal of income tax system, in contrast, is the equitable collection of revenue. Consistently with its goals and responsibilities, financial accounting has at its foundation the principle of conservatism, with its corollary that possible errors in measurement should be in the direction of understatement rather than overstatement of net income and assets. In view of the Treasury's markedly different goals and responsibilities, understatements of income is not destined to be its guiding light." Well, duh. Financial accounting, in short, is hospitable to estimates, probabilities, and reasonable certainties. The tax law, with its mandate to preserve the revenue, can give no quarter to uncertainty. So the issue here is that for accounting, you want to make sure that your investors, those people who will buy into the company, are not being sold a business that is making less than what they report. You want to understate. However, for tax purposes, we do not want you understating. If you're understating, you're not paying the tax that you owe. So there are different priorities, there are different reasons for computing income in a different way for accounting versus tax. The accounting method, however, for tax has to be the same as the method used to keep the books. And that's because you don't want something weird happening for taxes because you want to understate your taxes, where with your books, you're doing something different. So in order to satisfy this bookkeeping requirement, the IRS requires a taxpayer to reflect all adjustments on its permanent books and records or on permanent supplementary records. Permanent records include records that are prepared in the ordinary course of business that are sufficiently complete and accurate to provide a reliable and accessible basis for computing income, and are retained as long as the contents may be relevant for income tax purposes. This is required under Revenue Ruling 58-601. Internal Revenue Code Section 446A provides that taxable income shall be computed under the method of accounting on the basis of which a taxpayer regularly computes his income in keeping his books. So now we have to define what method of accounting is. That is defined as including not only the overall method of accounting of the taxpayer, but also the accounting treatment of any specific item. Examples of such overall methods are the cash method, accrual method, or hybrid method, as well as the various methods provided for the accounting treatment of those special items, including depreciation. Further, the tax court has held that the IRS's failure to challenge a taxpayer's accounting practices over a period of years, or its acceptance of returns based on an accounting method that does not clearly reflect income, will not preclude the IRS from later challenging the use of that method. So for example, a taxpayer who used a cash method for 23 years to account for sales of gems was nonetheless required to switch to the use of inventories and the accrual method once the improper method came to the attention of the IRS after 23 years of accounting and filing tax returns. Whoa! So this is a case by the name of R.D. Hudson, and it just completely shocked the tax community. So when you're doing your tax return, you must account for income in the same method that you did for your books. Always. No matter what people say. And this is something that a lot of accountants have a difficult time understanding. Now, let's move on to form of receipt. Gross income is not limited to cash received. It depends on how you do your books. So it includes income realized in any form, whether in money, property, or services. Income may be realized and recognized, therefore, in the form of services, meals, accommodation, stock, or other property, in addition to cash. This is according to Treasury Regulation 1.61-1A. Okay, so for example, Peach Corporation allows Bill, an employee, to use a company house on his vacation. Is this treated as income? And the answer is, yeah. Bill realizes income, and the amount of the rental value of the company house during the time that he's there. So let's go to another example. Emily owes $15,000 on her student loans at the end of 30 years of paying on the loan. The government forgives her for the remainder after 30 years of paying. So does she recognize income? And the answer is again, yes. She's going to recognize $15,000 worth of income because of the forgiveness of the debt. She no longer has to pay that back, and as a result, this increases her net worth. Now, let's go on to the next example. Josh began his legal practice in a building needing repairs. So Josh decided to list his services on a barter exchange where he offered to provide an hour of legal services in exchange for building repairs. A qualified carpenter performed the repairs in 8 hours. The carpenter normally charges $50 an hour. Josh charges $150 an hour for his services. Josh decided to do a little bit more for the carpenter, and so he took 10 hours to form a corporation for the carpenter in exchange for the carpenter's services. So, does he recognize income? Well, yeah. So because it took the carpenter 8 hours, and he normally charges $50, his services would result in gain to Josh of $400. Now Josh, as a lawyer, he charges $150 an hour, and it took him 10 hours. So there is $1,500 worth of increase to the carpenter. So what happens here? Josh includes $400 in his gross income, and the carpenter includes $1,500 in his gross income. So the question that was posed several episodes back about whether or not cookies in exchange for mowing somebody's lawn would be treated as income, this is where it comes from. It comes from the idea of a recovery of capital and whether or not you are going to be taxed on your increase. So the idea here is that both the carpenter and Josh had a beneficial increase based off of their services, and so we value that increase based off of the amount of the value of the services that they otherwise would have provided. You can't get away from paying your taxes just because you decide to go on a barter system. So that is everything that you need to know about income, how it's defined, when it is taxed, and who then has to pay the tax. If you liked this episode, please give it a thumbs up and subscribe if you would like to hear more about taxes. And please feel free to leave a comment in the comment box below if you would like to have a question answered, or you can email me at centerfortaxstudies@gmail.com. Thank you so much for watching, and we'll see you next time.